Right now, gold is sitting at 4,546.15, and we have the most conflicting technical setup I've seen in months. Monthly chart says strong buy, weekly says sell, daily says strong sell, and the 1 hour chart is screaming strong buy. This is a textbook trap setup that will wipe out 90% of traders who guess wrong. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now. Let me give you the instant market verdict first. We are in a range-bound session with a bearish bias on higher timeframes, but a bullish bounce is imminent on the shorter timeframes. The one invalidation level that proves everything wrong is 4,580. If we close above that today, the entire bearish thesis is dead, and we are heading straight back to 46.49. Write this number down. 45.57. This is the pivot level that decides everything. If we break above 45.57 and hold, the bulls take control. If we reject hard from 45.57, we are crashing straight to 44.54. Type 45.57 in the comments right now if you're watching this level with me. Now let's dive into the technicals, starting from the highest timeframes and working our way down, because that's how institutional traders think. The monthly chart is still in a strong buy trend, which means the long-term bull case for gold remains intact. The 200-month moving average is way down at 4,339.42, which is acting as the ultimate floor for this entire bull market. That's why every time we get close to that level, we see massive buying pressure come in from central banks and institutional investors. But the weekly chart is telling a different story. It's in a sell trend, and we've been making lower highs and lower lows for the past 3 weeks. The 20-week moving average is at 4,639.26, and we've rejected from that level twice now, which is a very bearish sign. Moving down to the daily chart, this is where things get really interesting. We are in a strong sell trend, and all the short-term moving averages are pointing down. The 5-day moving average is at 4,573.59, the 10-day is at 4,603.19, the 20-day is at 4,639.26, and the 50-day is at 4,711.52. Price is trading below all of them, which is classic bearish momentum. The 100-day moving average is sitting right at 4,647.36, which lines up perfectly with our key resistance level of 4,649. That's not a coincidence. That's where the big institutional sell orders are stacked. The RSI on the daily chart is at 40.667, which is not oversold yet, but it's getting close. The MACD is at minus 37.930, which is deeply negative and shows that bearish momentum is still strong. But here's what most traders miss. The 1 hour chart is in a strong buy trend. We've just bounced off the 4,454 support level, and we are seeing bullish divergence on the 1 hour MACD. That means even though price was making lower lows, the MACD was making higher lows, which is a classic signal that the selling pressure is exhausted and a bounce is coming. The 5 hour chart is neutral, which means we are in a transition phase between the daily bearish trend and the 1 hour bullish bounce. This is exactly the kind of setup that creates traps. The bears will be shorting every rally, thinking the downtrend will continue, and the bulls will be buying every dip, thinking the long-term uptrend is resuming. One side is going to get completely wiped out. The key support levels to watch today are 44.54 and 43.97. 44.54 is the immediate support that we bounced off yesterday. If we break below that, the next stop is 4,397, which is the last line of defense before we test the 200-day moving average at 4,339.42. The key resistance levels are 45.80 and 46.49. 45.80 is the first major resistance, and if we break above that, we are heading straight to 4,649, which is the 100-day moving average and the level that will decide the medium-term trend. Now let's talk about the fundamental drivers and cross-asset linkages, because this is what's really moving gold right now. The headline says gold gets smoked as yields rip higher, and that's exactly what's happening. Over the past 24 hours, we've seen a massive sell-off in the bond market, with yields across the curve spiking higher. The 10-year Treasury yield just hit its highest level in 11 months, and the 2-year yield is now above 4%. As you know, gold is a non-yielding asset, so when yields go up, the opportunity cost of holding gold goes up, and that puts downward pressure on prices. But here's the thing, this yield spike is being driven by inflation fears, not economic strength. The latest CPI and PPI data came in much hotter than expected, with PPI surging 6% year-over-year, the highest level since December 2022. That's why we are seeing this strange dynamic where inflation is going up, but gold is going down. Normally, gold is a hedge against inflation, but right now, the market is more focused on the Fed's reaction to inflation than inflation itself. The market is now pricing in a 40% chance of another rate hike by the end of the year, which is a complete reversal from what we were expecting just a month ago. Now let's cross-check this with oil, because gold and oil have a very important relationship when it comes to inflation and geopolitics. Oil prices have been rising steadily over the past few weeks due to escalating tensions in the Middle East. Every time there's a threat to oil supplies from the Middle East, oil prices go up, which pushes inflation higher, which should be bullish for gold. But right now, the inflation premium in gold is being completely overwhelmed by the yield premium. The market is saying that even though inflation is going up, the Fed will raise rates even higher to fight it, which makes bonds more attractive than gold. This is a temporary dynamic, but it's the one that's driving price action right now. The question is, when will the pendulum swing back? When will the market start pricing in the fact that higher rates will eventually cause a recession? Which is extremely bullish for gold. That's the million-dollar question, and the answer will come when we see either a sharp drop in economic data or a major geopolitical event that triggers a flight to safety. Looking out over the next 1 to 2 weeks, my directional lean is bearish with a bullish bounce first. I think we'll see this 1-hour bounce continue up to the 45.57 to 45.80 resistance zone, where we'll get a hard rejection, and then we'll resume the downtrend down to 44.54 and possibly 43.97. The exact event that would invalidate this thesis is a close above 45.80 on the daily chart. If that happens, it means the bulls have taken control, and we are heading back to 46.49. The other thing that would invalidate the thesis is a major geopolitical event in the Middle East that causes oil prices to spike $10 or more in a single day. That would trigger a massive flight to safety into gold, and we would gap up above all the resistance levels. Most people will skip this next part, but this is where money is made. Keep watching. I'm going to give you 3 exact trade setups for today, each with clear entry conditions, stop losses, and targets. The first strategy is the sniper for conservative traders. This is the highest probability setup with the best risk-reward ratio. The trigger condition is a rejection from the 45.80 resistance level with a 1-hour bearish engulfing candle. You enter short at 45.75. The stop loss goes at 45.95, which is just above the resistance level, to avoid getting stopped out by noise. The first target is 4,520, which is a 1 minute and 2.75 seconds risk-reward ratio. The second target is 4,454, which is a 1 minute and 6.05 seconds risk-reward ratio. This setup is voided if we break above 45.80 and hold for 2 consecutive 1-hour candles. The second strategy is the active trader for standard risk tolerance. This is a mean reversion play that takes advantage of the 1-hour bullish bounce. The entry condition is a pullback to the 4,520 support level with a 1-hour bullish hammer candle. You enter long at 45.25. The stop loss goes at 45.05, which is just below the recent swing low. The first target is 4,557, which is the pivot level, with a 1 minute and 1.6 seconds risk-reward ratio. Once you hit target 1, move your stop loss to break even and let the rest run to target 2 at 4,580, which is a 1 minute and 2.75 seconds risk-reward ratio. If we break above 45.80, you can trail your stop 20 points behind the price and aim for 46.49. Let's see how aligned we are. Type your goal target for today in the comments now. I'm reading them. The third strategy is the Aggressor for high-risk traders only. This is a counter-trend play that bets on the daily bearish trend resuming immediately. The entry condition is a failure to break above 45.57 on the first test. You enter short at 4,555 as soon as you see price start to roll over. The stop loss goes at 45.70, which is very tight, so this is only for traders who know how to manage risk aggressively. The first target is 4,520, which is a 1 minute and 2.33 seconds risk-reward ratio. The second target is 4,490, which is a 1 minute and 4.33 seconds risk-reward ratio. I want to be very clear about this. This is a high-risk setup. You have a higher chance of losing on this trade than the other two, but if it works, the profits come very quickly. Only take this trade if you're comfortable with the risk and you have a strict stop loss in place. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable to summarize. The one most critical level for the next session is 4,557. If we break above and hold, bulls win. If we reject hard, bears win. Tomorrow, we'll be focusing on the weekly jobless claims data and any developments in the Middle East that could impact oil prices and inflation expectations. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen. I also just uploaded the WTI crude oil analysis, which is critical for understanding gold's inflation premium right now. Smash like if this analysis gave you a clear plan for trading gold today. Subscribe and hit the bell for daily coverage of all 8 key assets, including Australian dollar to US dollar to Japanese yen, Nike 225, euro to US dollar, pound sterling to US dollar index, and S&P 500. I upload every single day before the London session opens, so you always have the latest institutional grade market intelligence before the big moves happen. I'll see you in the next one.